This is Procurement Spectrum. Every software renewal you sign is priced against a cost you have never been allowed to see. Let me show you the one number that gives it away. Start with one uncomfortable fact. Once a piece of software exists, the cost of producing one more license for you is close to zero. So the price you are quoted is not built up from cost, the way a hardware quote is. It is built down from whatever the publisher thinks you will pay. That is why a pure software publisher can keep around 77 cents of every dollar you hand over. The number on your renewal is a negotiation, not an invoice. Which raises the question this whole briefing is built to answer. If the cost of the next license is basically nothing, what is actually setting the price, and how much of it can you move? The answer is sitting in a document the publisher is legally required to publish, its own financial statements. Let us read them the way a negotiator should. Software is the most asymmetric negotiation most procurement teams ever face. The publisher knows its own cost base, its sales incentives, the gap it needs to close this quarter, and the odds you will renew anyway. You typically walk in knowing none of that. The financial filings are how you take some of those cards back. Read the filings, and $1 of your money splits in a way that surprises most buyers. Sales and marketing is usually the single biggest line, often between 25 and 40% of revenue. Roughly a third of your money pays the people selling to you. Research and development, the actual product, is smaller, typically 14 to 20%. Cost of delivery and overhead take another slice. And what is left, the operating profit, is wide. Here is why that matters. That selling line is your room. On a quiet renewal, the publisher barely spends it, which is exactly where the discount can come from. The full framework runs to 9 metrics, but 4 do most of the work. Learn these before your next renewal call. 1. Gross margin. For pure software, this sits between 70 and 85%. It is the floor below which the publisher cannot discount without booking a loss. 2. Operating margin. This is the cushion. It tells you how much the publisher can give away and still hit the earnings number its shareholders expect. 3. The sales and marketing ratio. When it is high, the publisher has structural room to discount on the deals where it barely had to sell to you. 4. Free cash flow. The real cash left per dollar. High and stable cash flow is the clearest sign a publisher can afford to move on a strategic deal. Now the receipts from 5 publishers you almost certainly buy from. These are their own filed numbers. Oracle reports a gross margin of about 76% on $53 billion of revenue. Salesforce, 77% gross margin. For every dollar of software, roughly 77 cents is left after the cost of delivering it. Microsoft runs a group operating margin near 45%, and its Office and Dynamics segment is reported above 50%. Even Oracle's operating margin, after stripping out the accounting adjustments, sits at 44%. Read plainly, none of these are suppliers who cannot afford to move. One trap to avoid. Every publisher reports 2 profit numbers, and the gap between them is a signal in itself. Salesforce reports a GAAP operating margin of 19%, the strict number with every cost included, and a non-GAAP margin of 33%, the flattering one the sales deck will quote. That 14-point gap is mostly stock handed to employees. It is a real cost to shareholders. Always read the lower number because it is the one the publisher is trying to protect. Here is the warning that comes with all of this. A strong margin is the capacity to discount. It is not a promise to. When Broadcom acquired VMware, it collapsed roughly 168 product bundles down to 4, and buyers documented license cost increases of 800 to 1500% on some setups. Same rich margin profile, the opposite outcome for the buyer. High room plus tight discipline does not give you a discount, it gives you a price rise you have to plan around. And this is the limit the financials do not show you. Margin tells you the room exists. Switching cost tells you whether you can ever reach it. For deeply embedded systems, core ERP, an established CRM, your primary cloud, The cost of leaving frequently exceeds 5 years of what you pay to stay. The publisher knows this better than you do. A 75% gross margin is meaningless as leverage if you were never realistically going to move. So where is the room, if not in a straight discount? Follow what the publisher is desperate to sell you. SAP is a clean example. SAP's cloud revenue reached about 17 billion euros and grew 25%. But its contracted cloud backlog jumped 43% to 63 billion euros. That is future revenue already signed, but not yet earned. A publisher pushing that hard to move you to the cloud will trade the credits, the transition help, the flexibility. They live in that move, not in a flat renewal of what you already run. There is one lever that works almost everywhere, and it is free: timing. A sales team is under the most pressure to close in the final weeks of its own fiscal year, and every publisher closes on a different date. Microsoft in June, Oracle in May, Salesforce in January, SAP in December. Close on your calendar, mid-quarter, and you have handed back your best structural lever. Close on theirs, and the desperation is working for you. So what do you actually do with all of this? 4 moves before your next renewal. 1. Read the filing before the call. Walking in able to quote their own operating margin back to them changes the conversation from "please discount" to a structured commercial discussion. 2. Time the deal to their fiscal year end, not yours. It is the single most reliable and most ignored source of leverage in software. 3. Negotiate the whole category at once. Publishers give far more through bundles than through line-by-line cuts, because a bundle protects their list price. 4. Put a genuine, evaluated alternative on file. It does not need to be one you will deploy, but it has to be real. A documented option beats a bluff every time. And one warning to close on. The most common misuse of this analysis is to treat it as a discount calculator. The framework is descriptive, not predictive. It tells you where room exists. Whether the publisher opens it depends on your switching cost, your contract, and their discipline. Bring the number, but never lead with it alone. Every briefing ends the same way, with the Spectrum Scorecard, 4 dials on where things really stand. Publisher margins, very high and disclosed in black and white. Real room to give, structural, the capacity is genuinely there. Your true limit, not their margin, your own lock-in. And the one free lever anyone can pull: timing. Match your calendar to theirs, and you reach room the unprepared buyer never touches. Buyers who argue with the sales narrative keep paying list. Buyers who read the filing, time the clock, and negotiate the whole category reach the room those numbers say is really there. You will find the full framework, the 9 metrics, and the free negotiation tools waiting at procurementspectrum.com. Come back for the next market we take apart.